Let's bring in former SEC Chairman Harvey Pitt. He's here to join us, as well as Wall Street Journal Chief Economics Correspondent John Hilsenrath and Fox News contributor Jonathan Hoenig of Capitalistpig hedge fund. Jonathan Hoenig, I want to start with you because it's good news for most of that. Let's focus on the positive. Leave Capital One aside for the moment. The reason Adam said that Warren Buffett's going to be happy about Bank of America is he has preferred stock. He said if it passes, he's going to trade it in for common stock because they're going to up their dividend quite a bit. So that means a lot of money to that guy.
A lot of money to that guy and to investments in shareholders and banks, David. I mean, historically, this news from the Federal Reserve has been very good for bank investments. They've tended to trade it up after this news was released in previous years, and we've already started to see this, as we talked about Citigroup, Reasons Financials, American Express, all these stocks building on the rally that basically started after the election, up about 22%. I think if you get even more regulatory relief, specifically Sarbanes-Oxley, you'll see these banks continue to rise. They're the new leadership of the market right now.
John Hilsenrath, let me talk about the relationship between the Fed that's doing these tests and the new administration, the Trump administration, because a lot of people say there's a misalignment here. Trump administration wants to release the banks from a lot of their commitments that they're meeting, apparently, in these stress tests. They think there's not enough lending going on, whereas the Fed is still obviously has a lot of interest in these tests. How does that misalignment get aligned, if it does at all?
Well, I mean, I think what we might be seeing here is the Fed moving a little bit in the direction of the Trump administration. You know, the banking community had been very critical of the way the Fed had been doing these stress tests, and particularly the second phase where they do qualitative assessments of their processes, their capital planning processes. What we see today is the Fed saying, all clear, you know, we're for the most part all right with everything that you've been doing, and go ahead and pay out those dividends. It looks like the Fed is moving a little bit towards going a little easier on the banks.
Interesting.
I think one of the reasons that might be going on is because the toughest regulator at the Fed, Dan Tarullo, retired earlier this year. And you have a Republican now, Jay Powell, who's running that committee that does the stress test process.
Well,
so, you know, I think the Fed sees that they felt they had to be very tough after the financial crisis.
Right.
You know, maybe they're easing up on these guys a little bit now.
But Harvey, Pitt, we have been hearing for years now that the pendulum swung too far in terms of safety. That is, banks of the whole country had become too afraid of risk. Maybe that's changing now.
Well, I think it's changing, but not in an excessive way. We're looking at prudent risk and having the comfort of at least an in-depth stress test and review so that people have confidence the banks have enough reserves and capital available to make sure that they can deal with any contingency.
Harvey, let me stick with you for a second. Are these stress tests really necessary? I mean, is it too much to ask for the banks to kind of monitor their own reserves? Would that lead to another crisis? Or perhaps can we move the Fed out of these tests?
Well, I think that there is clearly room to move the Fed out of these tests. As I said a moment ago, however, I think prudence requires that it be done gradually. I think these banks have the ability, the know-how, the expertise to make certain that they have enough capital reserves and that the Fed can set the standards for them, but we don't need the kind of in-depth, invasive presence of the federal government in all of this.
John Hilsenrath, what do you think of that?
You know, well, I'd say a couple of things. One is, you know, this question is really central, I think, to the future of the Federal Reserve itself, because Janet Yellen's term is coming up next year. Donald Trump has said nice things about her and the way she's managing monetary policy. You know, he thinks that she's a low-interest rate person and he's a low-interest rate person. Where they differ is on the regulatory environment. She's defended the way the Fed has managed the oversight of banks, and she's prepared to go to the mat on some of these things. And I think his decision about whether to renominate Janet Yellen to run the Fed could hinge on how he sees her from a regulatory perspective.
Politics is everywhere. John Hilsenrath, Harvey Pitt, Jonathan Hoenig, I owe you one. We got to move on. We got some breaking news. Thank you very much. Melissa.